Yeah, so for founders who may not know your firm yet, could you give us a quick overview of D3 VC, what you guys focus on, the type of companies you back, and the stage and check sizes you typically invest at?
Sure. Well, first, thank you for having me. It's great to be here with you. So D3 VC is an early stage venture fund. We invest in a very unique segment of the marketplace, not just early stage, but companies that are raising money through investment crowdfunding. So these are issuers that file with the Securities and Exchange Commission to raise money online. They file to raise up to $5 million, mainly from their friends and family and followers. We track every single Reg CF, that's what they call it, offering through our database. We've been tracking it since the industry launched in 2016. And we built an algorithm that looks for predictive signals in the data. So thanks to AI and machine learning, you can actually build these algorithms that actually show where signals match. And so what we did with our algorithm is we said, we can look at companies that have gone on for a follow-on round of financing. And we can see the signals that they had in terms of revenue growth, hitting milestones, and track those. So quantify those. And then with companies that are coming into the data set, we look to see, do they have similar predictive signals? If so, they rank higher in the algorithm. We also track how many investors are coming in from the crowd, how much money they're putting in. And then each week we're fed up a list of companies to diligence. And so from that, and it's completely industry agnostic. We are looking at healthcare, technology, restaurants. I mean, it's just across the spectrum. It's all about, does the company have what is needed to go on for a follow-on round of financing? And does the team have a strong team, great IP? And we can talk about this more later on. But, so D3 VC is our venture fund built around that algorithm that then invests in select of these offerings. And it's been, we've made 21 investments in the past little over a year. 5 of them have already gone on for a follow-on round of financing. They've marked their valuations up 35%. So knock on wood, I think we're doing a pretty good job.
Yeah, you guys have quite a unique approach to how you deploy capital. And in terms of the companies that you are looking at, are you looking to be the lead, support investors? What's kind of the check size you kind of play around with?
Right. So when you think of early stage VC, you always think of people that are going to be the lead, right? That's the logical thing. That is not what we're doing. We are one of these followers, but we're not following other VCs per se. We love it when VCs are in there because they've also given us a proof point as to why we should be listening to this deal. What we're doing is we are looking at the signals of the crowd. So we actually don't invest in, even look at a deal to invest in until it's hit $124,000 of commitments from other investors. So mainly the friends, the family, the followers, because we want other people to have skin in the game. And that brings a little more credibility to us doing our diligence on it. We want to understand, what do these people see in the deal that make them excited about it? And that's how we decide if we're going to do it. So we're never a lead. We're writing a lot of, $25,000 mainly checks into these deals, with the goal of having a portfolio of about 200 companies. And out of those 200 companies, VCs look to have, one outlier, that is like 100x. Our thinking is, and if you look at what MIT and Harvard, PhDs, guys that have studied, portfolio diversification and returns, it comes to the broader the net, the wider the net, the more companies you invest in, the higher the returns. And so our thinking with our fund algorithm is, let's invest in a lot of these companies that the algorithm pinpoints as ones that we should diligence. We pick up the phone, we meet with the CFO, we ask a bunch of questions like VCs do, and then we make our investment, but it's never going to be the lead investment. So, but what it does though, this is a fascinating thing that sort of dovetails on your question. We make our investment, people follow us. So there's a lot of people on these investment crowdfunding platforms like WeFunder and Start Engine, where these deals are taking place. They can see the deals that we're investing in, and they're like, listen, these guys at D3 VC did their diligence. Clearly, it hit their algorithm. They made an investment. I'm going to follow them. So we got a following of investors that we can bring into deals. So it's not just our investment, it's the following. But the interesting thing about our LPs, and so if you know the venture fund sort of structure, you've got your general partners, which are the people like us, that, or me, that are running the funds with my other partners in it. There's 7 of us in our fund. And then you've got your LPs, and those are the limited partners. Those are the people that give us the money and say, hey, invest my money on, my behalf. And that's how you get a venture fund. And so we've got those LPs that are investing. And what's been fascinating is several of our LPs are like, listen, Woody, when you make an investment, send me, so we do a deal memo for every company we invest in. As a matter of fact, today's Tuesday. Tomorrow's our venture fund call. Tuesdays are crazy for me because I have to go through the algorithm, look to the companies that went to the top, follow up with the companies that we have questions on. There's a lot of follow-up work. And then I make these deal memos that are 7 pages long on each company we're going to go over. So these investors say to me, Woody, when you make a decision, send me that deal memo, but send me the notes related to why you decided to invest in the company. And they're going in with their own checks. Some, in many cases, bigger than the ones we're putting in. So we've got this sort of, crowd effect happening within our fund that's very different from a typical venture fund because we make our own investment, not the lead. People follow us through the crowdfunding platforms, and our LPs are co-investing in addition to what they've already put into the fund.
Okay. I really appreciate the depth you went into in that answer. It really gives us a good understanding of who you guys are and how you operate. And on that note, I want to speak more about kind of founders and kind of help them. So I want to ask you, what separates founders who successfully raise capital from your POV, from those who struggle to get investor traction?
So again, our founders that we're looking at are all founders that are raising money online through investment crowdfunding. And by the way, investment crowdfunding is a global thing. I worked in 43 countries through the State Department and through the World Bank, traveling around the world, helping these countries create these ecosystems to allow investors to invest in startups all around the world. So if you are listening to this in the United States, yes, we do this. Everyone knows, not everyone, but people know about it in the UK. Of course, this is happening in Europe. But, this is a global opportunity. It's got regulations for each jurisdiction under which it operates, but it allows people to invest in these companies. So wait, I got sidetracked.
Question?
Yeah.
No, I like the rant. I was asking what you think separates founders from those who successfully raise and those who don't.
This is what happens when your brain goes 1,000,000 miles an hour. Okay, so with the investors, so the founders that stand out to us that are raising money through investment crowdfunding, hence the sidetrack, are a unique group of people. They've already decided, I'm going to put my company online. I'm going to put all these disclosures about my company online. I'm going to open the kimono, so to speak, and tell people everything they need to know. We love that, because it shows a degree of openness, transparency that you might not otherwise get in the private capital markets through private investing, because there's no regulation forcing you to actually do things. So we love these founders that come online through investment crowdfunding because we get to see more of what's happening in their company. B, that it's not just transparency, it's communication. So the things that we're looking for when we're looking at these deals are founders that can do a very, very good job of explaining what they're doing, why they're doing it, how they're doing it, and why they are the right people to do it. So it's looking at the whole thing holistically and saying, I saw this problem, I came up with a solution, I have the background and experience either through education, by working in a prior company, somehow to make me the right person to do this job, and even better, I've scaled a company before. So we look for signals. Do you know how hard it is to be an entrepreneur? Do you know how hard it is to grow a business? Do you know how hard it is to raise capital? If they check these boxes that they've done this over and over, we're like, okay, I want to talk to you because you've got the signals again for someone that understands what it's going to take to scale and probably exit a company. So communication's critical. The other thing is someone that understands capital formation and capital raising. So when you're raising money from investors, it's not just a conversation, it's a negotiation. And part of that negotiation is, what is your company worth? I'm just going to be plain about this. If you have an idea, it's worth nothing. Nothing, zero, nada. Don't tell me your idea is worth 5 million or 10 million. It's worth nothing. If it's worth 5 million or 10 million, go out and sell it immediately and take that money and go on a vacation. If you can't sell it for 5 or 10 million, then it's not worth 5 or 10 million dollars, period. So don't try and come to investors and say this idea that I have is worth 5 or 10 million dollars if in fact no one's going to give you the money at that valuation. So I really appreciate entrepreneurs that understand the risk investors are going to take, that it's their money that's going to help them get to the next level. Yes, you have to execute it, but you can't execute anything without that capital. And they're realistic about what the company is worth at that stage of that company's evolution. So entrepreneurs that understand that and are realistic about their valuations, and or, by the way, again, I said it was a conversation. If you can defend your valuation and why you have it at that level, then we've made investments in pre-revenue companies, mainly healthcare, because the future potential is huge, and they've done things. They've hit milestones to prove that they've done that. So, the founders that are transparent and communicate on these platforms, you have to answer questions all the time. If you're not answering our questions, boy, we pass on the deal immediately. Like, why would we invest in your company if you're not even going to answer our questions when you're asking for our money? Like, that just means that down the road, you're not even going to be paying attention to anything we're going to ask in the future anyway. So we just skip over those companies too. But, the experience that you have is critical. Your ability to communicate is critical. Your understanding of capital formation is critical. So those are some of the main things.
Yeah. And whilst we are on the topic of kind of the valuation of startups, how do you guys, or let me ask this actually, what factors matter most to you when you're determining a startup's value? And I would love for you to speak about your signals and anything you guys use, if it's not confidential, to kind of determine this too. But yeah, tell us about how you determine a startup's value.
So there's a few different ways that you have to look at valuation, and you have to consider a company at its stage in evolution. So how old they are, and if they have, or if they're pre or post revenue. If they're post revenue, you can start to benchmark them off of similar companies in similar industries at similar stages of evolution, to see where their valuation lines up. So there's all this math that's happening, because you want to see, are we investing at the same, lower, or would it be a higher valuation? If it's a higher valuation, what justifies that? So that's whole one part of the equation. The other, and that's where, if they've got revenues, it makes it a lot easier. If they are pre-revenue, then you have to look at the market that they're in, the potential of what they can achieve with that market. And then you have to look at what you think is their ability to actually achieve those milestones that will lead to that future outcome that justifies that valuation. So it really depends on the company that's in front of us to then look at it from the valuation perspective. But I'll just tell you right off the bat, I mean, there was a company that was raising money through investment crowdfunding that scored very high on our algorithm, had lots of investors, they've raised a ton of money from other people. And they had it was a beverage company. They had $115 million valuation, and they had $1 million in revenue. And I was like, where, what, where, who, what, these poor investors, like, what are you thinking? Like, you cannot justify that as a beverage company where the competition's insane. There's so many other people coming up with competing different type of, I can't remember if it was kombucha or what, but your ability to break out and win in that space is already very challenging. And so you really have to prove your scale, and the multiples in a beverage company are not the same as the multiples in a software company, okay? Because a beverage company is not going to sell for an outlying thing like an AI software company that integrates with, one of these companies right now that solves a problem that they can't solve is going to get. So the valuation, it's a moving target, but there's one that you just have to apply, our logic to and other people's logic to.
Sure. And obviously you've mentioned a few key things there, especially from a qualitative standpoint, both pre-revenue and they're producing revenue. Are there any specific metrics you're looking at? Numbers, maybe your unit economics, or maybe even models, potentially a DCF, anything in particular from a numbers perspective?
I mean, I'll just tell you right off the bat, I think DCF, well, it's a lovely exercise and it works very well for companies that are generating revenue. Um, uh, I am completely opposed to it if you're not generating revenue and you don't have a history of generating revenue, because then you're doing a discounted cash flow on pro formas. Like, I'll give you a pro forma with a DCF that makes me look like I'm worth $1 billion. I'm not. So DCF works in certain scenarios. And you know what? If you are a larger company, you've got a history and revenues and cash, we'll look at that. But for the most part, a lot of these early stage companies are just starting to generate revenue. And so a DCF doesn't necessarily work very well for them, but we look at, multiples of revenue. We look at earnings. We are very impressed with early stage companies that can both scale their business and bring some profit to the bottom line. That's a very difficult thing to do because most of these early stage companies are reinvesting whatever money they make back into the business. So, if you have the ability to create revenue for which we can see, and by the way, that to your point, every conversation for our Wednesday fund call begins with, this is XYZ company in front of us. Here's their valuation. This is their multiple. Okay. It's right up top. If that multiple is over 10x, it's going to be very hard for us to continue diligencing it. If it is at 10x, we want to know, why do you have that high of a multiple? Like, what's so great about you that earns that multiple? We do look at some of that stuff, but for the most part, we've got our own way of considering the multiples.
Sure. I appreciate that. And that was a quite broad perspective in terms of how startups are looking at their numbers and how you guys kind of see it as well. So I appreciate that. And I kind of want to talk more about kind of the current trend, because you're seeing at the forefront, especially for your algorithm, you're seeing how companies are coming through from a crowdfunding perspective. But in your opinion, what major shifts are you seeing in venture capital in general right now that founders should understand?
So, and this is, I'm going to be talking to you about what I'm seeing, particularly in the United States. Okay. So I'm sure these trends could be similar in other countries, but I have just personal experience with this. So if you recall, we had the collapse of the Silicon Valley Bank a few years ago. With the collapse of Silicon Valley Bank, you've got the venture capital firms that stopped investing. They were like, okay, we're not making any new investments. We're going to keep our portfolio companies alive by making sure they're hitting their milestones and they're growing. We'll take calls. We'll talk to people because, it's always important to keep on, the communication going, but we're not really investing. And then a year into it, they're like, okay, let's start investing. But you know what? This early stage stuff is way too risky for us. Let's move upstream. This, by the way, is a story that we've heard over and over again. Before venture capital, before angel investing, it was private equity. And private equity owned the whole landscape. And then private equity decided, you know what? Early stage companies are too risky. They moved upstream. Venture capital came in. Venture capital started investing in all of this. And then venture capital had realized, you know what, private equity is smart on something. The bigger deals, they can write bigger checks, tend to be less risky because these companies are much bigger, harder to fail. So they might not get, 100x outlier, but they might get 10 times return on their investment. That's pretty good. So they're moving upstream now. So it's creating this hole, this opportunity for other early stage funds like ourselves to come into the marketplace and be like, okay, buy VCs, traditional VCs, buy private equity. You know what? If you're an entrepreneur and you need capital, go online, look for capital from your friends and family and followers. And there will be other venture funds like ours that will co-invest alongside these deals. So I haven't seen the tide necessarily. I've heard more VCs talking about, yes, we're investing in early stage again. They're investing in AI early stage, okay? They're not investing in all the early stage. It's a very unique part of the marketplace that they're focused on because that's where everyone's excited about the potential. So it creates this opportunity for us in the marketplace to be looking at all these different deals, including AI. I don't see that trend changing anytime soon. I think, we're working on I'm very active in policy work in both Washington, D.C. and with the SEC, advocating for, right now a venture fund can't crowdfund. So only rich people can invest in a fund. I think, if we can allow retail investors to invest in startups, why don't we allow retail investors to invest in early stage venture funds? Yes, that totally benefits me. I'm not trying to pull the wool over your eyes, but I'm just saying, why not? Because what it does, by the way, it gets more retail investors into a part of the capital markets that has been precluded to them forever, where rich people have gotten richer. So I'm not saying that this removes the risk. I'm saying if we do what investment crowdfunding has allowed people to do, which is invest a small amount of your money into risky companies, you're not going to lose your shirt. Okay. But you do have the potential to have an outsized return that you're not going to get by investing just in the, New York Stock Exchange.
Sure. Sherwood, I honestly, genuinely resonate heavily with the idea of retail investors being able to become LPs. I think that's a great idea. I know that's very much benefits you. It doesn't actually benefit me, so I'll actually resonate the sentiment and I reiterate that that's actually a really good perspective. And I think you're one of the first people I've seen put a positive spin on the SVB collapse. So that's a good way to put it. They are leaving a hole in the market in terms of VCs moving upstream. So that's a really good way to put it. Now, obviously, it's quite clear you guys with your algorithm and how you approach deploying capital. It's quite obvious you guys do a lot of your own deal sourcing and your own scouting. But let me ask you this. When a founder reaches out to you, what actually makes you respond to them? Do you respond to them? And if you do, what makes you take that first meeting?
I do respond when people reach out. I am getting bombarded with just spam from people right now. And I will tell you that I created a filter because if you are just using one of these lists to do an outreach to investors, it's a lot of investing is relationship based. And so if you don't have that relationship, a cold outreach is typically, I mean, I'm not really investing, but if someone were to reach out to me and be like, I'm interested in crowdfunding and I want to get on one of these platforms, what do you think are the keys that I need to be, the keys to success for this for me? You're going to miss my algorithm because my algorithm just scans through things that are generic and throws it into trash. But I will then personally respond to you and I'll tell you a couple things. I'll be like, listen, this isn't rocket science. I've got 2 books, one that's 400 pages and one that's 150. You can read this in one day. This is a go-to guide. It's called Investomers, the handbook. And in one day, you can learn everything you need to learn about putting together an offering, how to be successful with it with investors online. And my goal with this is get more people through investment crowdfunding. So then you come to me in the algorithm. I tell people all the time, Google investment crowdfunding, look at the largest investment crowdfunding platforms, WeFunder, Start Engine, these are US ones. If you just in any country, you can just type in, investment crowdfunding UK. You'll find Cedars, you'll find, like all the other big names there. But this happens globally. So I tell them to do that because the reality is we as investors want to see traction because traction is a proof point. So we want to know that you are actually doing something rather than just sharing an idea. You are actually building something rather than asking for money. You are proving that you are worthy of a check later on by showing that you can achieve milestones even before you've got any, significant investors willing to back you. That's how you prove yourself as an entrepreneur. And those are the type of things that I tell people when they come randomly knocking and mentioning crowdfunding.
Sure, for sure. And I'll probably say this as well. If all else fails, just quote something from Investomers. I think they'll probably get your attention either way.
Exactly.
But yeah.
Wait, what?
On that note as well, because you kind of made it quite clear, a lot of founders take the wrong approach when they're reaching out to whether it's investors or just capital in general. How would you, and what would you say actually are the 3 biggest mistakes that founders make when raising capital?
Sure. The number one mistake is just throwing a broad net, hoping for something without having the relationship. The best thing to do is you can go online to investment crowdfunding. It allows you to establish a relationship very quickly through a platform that has pre-existing relationship with investors that invest in companies that might be in your industry. But if you don't have that, just the cold net is a big mistake. The second is setting the wrong valuation. You set the wrong valuation, you can just close conversations right off the bat. So you need to have a valuation that's realistic, grounded in something, that's easily understood. And the third thing is communication. If you are not communicative, if you don't respond to questions that investors have, you're killing any opportunity for you to raise capital down the road. So you want to be, before you get their money, you want to answer their questions. When you're raising money, you want to answer their questions. And by the way, after you raise their money, if you want to do another round later on, you better answer their questions. You better tell them how your company's performing, tell them the good, tell them the bad. Boy, if you got bad news, share. By the way, if you have bad news, share it instantaneously, because these investors want to make sure that their investment doesn't go away. They will brainstorm with you to make sure that you can overcome whatever challenges you have. There's a whole, we as individuals get caught up on, oh, I'm just too afraid to tell people the truth. You know what? Maybe that works in personal scenarios, but when it comes to investors, they just want to know how they can help you. So if you're not doing anything wrong and there's a challenge that you have in your business, turn to your investors as a way in which you can get marketing, get a solution to a problem, have them come in and help you build an inventory system that you don't know how to do on your own. A lot of your investors or the crowd probably has that experience and they're willing to help you. Don't do it and risk, any future capital.
For sure. Those are some really good insights. I think one thing I always do tell the founders that we work with is it builds a lot of trust when you lead with the bad and you let them, well, I won't say lead with it, but you very much include the bad and where the biggest risks are in the business. It really, really opens up transparency and trust with an investor or a prospective investor. And yes, we have a segment at the end. It's called Please Stop, Please Start. Essentially, what I want you to do here is I want you to tell me one thing you want startup founders to please stop doing, and then one thing you want them to please start doing. And this can be in relation to anything: valuation, due diligence, outreach, anything. And the two answers do not have to be related.
Okay. So the one thing I want entrepreneurs to stop doing is buying lists of investors and doing cold outreach. It's a waste of your time. It's a waste of your money. It's a waste of my time. I'm not responding, and I don't know any of my friends that are. So stop. Just stop. You're giving money to people that are making promises that they're not delivering on. The next thing that I want them to be doing is you need to understand that raising capital is not a one-size-fits-all process. That there are friends, there's family, there's venture capital, there's angel investors, there's investment crowdfunding. Think of it as a 5-lane highway, and think of it as you own 5 different cars and you need to have people driving in each of those lanes trying to figure out how you can get the capital at the end of the road. So don't pigeonhole yourself into one lane and one car. Be open to, who do I have in my network? All of the people that are very successful with investment crowdfunding, look at their network and be like, how do I target my network and how do I leverage my network for other investors? So spend some time thinking about who you are going to soft circle money from, and then when you're ready to launch, engaging them when they invest in their network of people to invest in you as well.
Sherwood, you've been absolutely amazing. Do you have any final notes for us? And please, if you can, speak about your books. But yeah, before we wrap up, anything else you want to add at the very end here?
Okay, so selfishly, I will tell you to go onto Amazon and buy Investomers. This 400-page book, I've been working on this industry for 15, 16 years. I've worked for the World Bank. I wrote the law here in the United States. I was at the White House when President Obama signed it into law. I did all the lobbying with a few other people. I testified in front of Congress. I worked for the World Bank. Like I said, I've traveled around the world. This is my brain. So if you want to know everything about investment crowdfunding and you want to get a good night's sleep, pick up this book, because it's sort of like the academic read into what this whole industry is about. And I have a chapter in there where it talks about the keys to success in these offerings. And that chapter led to this book, which is, a lot of people don't care about the academic. They just want to know the how. And so the smaller one, it's literally a one-day read. Both of these books are available on Amazon. You will understand everything you need to understand about putting these offerings together and how to succeed with investment crowdfunding. There's great things at the end that tell you who else to speak to. So there's just tons of information in there. So buy my book.
Amazing books. We got the theory and we got the practical, more or less. Sherwood, thank you so much. You've been great. It's been great having you.